Imagine a business operating during a strong economic expansion. Sales tick up just a few percentage points, but underneath the surface, profit margins explode upward. Investors love this. Wall Street aggressively bids up the stock, valuation multiples stretch to new highs, and the company is praised as a perfectly efficient, highly scalable machine. Then, consumer demand slows down just a fraction. Almost overnight, those massive profit margins vanish. Cash flow evaporates, layoffs begin, and the company struggles to service its mounting debt. How does a highly profitable, highly celebrated enterprise edge toward bankruptcy over a tiny dip in sales? The answer lies in a structural mechanic known as operating leverage. It acts as an aggressive amplifier, magnifying the upside during a boom and accelerating the damage during a bust. Operating leverage measures how heavily a business relies on fixed costs. These are the mandatory expenses that a company must pay regardless of whether short-term sales are breaking records or falling flat. We see this structure in businesses that require massive upfront capital. Building software infrastructure, leasing retail space, keeping an aircraft fleet grounded, or carrying a large corporate payroll. Whether 10 or 200 people buy tickets, a movie theater pays the exact same rent, electricity, and salaries. These form a rigid fixed cost threshold. But once ticket sales cross that line, infrastructure is fully paid for. Every additional dollar becomes highly profitable revenue. Heavy fixed infrastructure functions like a coiled spring. It guarantees that any extra revenue generated above that break-even line creates rapid, explosive earnings growth. DOL divides profit change by revenue change. Company A's revenue rises 10%, profit jumps 30%, a DOL of 3. Company B's profit rises 12%, a DOL of 1.2. If revenue drops 10%, A's profit plunges 30%, while B declines 12%. A high DOL acts as a strict mathematical multiplier. It forces profits to collapse at the exact same aggressive rate they grew, exposing large infrastructure as a severe liability when demand cools. Let's compare two competing business models. Company A operates luxury cinemas with massive real estate obligations. Company B runs a streaming service, paying for variable server space and digital marketing. When an economic downturn hits and consumer spending slows, Company B survives by flexibly scaling down its server capacity and pausing ad campaigns. Company A cannot pause its real estate leases. Its fixed costs remain frozen, and it bleeds cash rapidly. When borrowing costs rise and credit tightens, losing operational flexibility becomes a fatal liability. In these harsh environments, surviving a downturn is much more important than maximizing growth during an expansion. Curious, slightly skeptical. This exposes a common misunderstanding in investing, the assumption that higher profit margins automatically indicate a stronger business. During economic booms, markets often overvalue companies because their margins look spectacular, but those numbers are temporarily inflated by favorable operating leverage. The moment revenue dips back below the fixed cost threshold, the margins crack under pressure. The warning signs are clear: high fixed costs paired with unpredictable cyclical demand, heavily leveraged balance sheets, and low cash reserves. Professional analysts look past headline profitability. They dissect the underlying cost structure to find the break-even point, testing exactly how much revenue pressure the business can withstand before it starts taking losses. Evaluating corporate health requires looking beyond current success. The smartest approach is to examine a company's structural rigidity and ask, what happens to this business if revenue falls even slightly?